Peter Lynch opens Chapter 5 with a clear, friendly warning. Please do not ask him whether we are in a good market or a bad market. He says the question is almost always unhelpful, and that neither he nor any other expert can predict markets reliably. What matters far more is finding the right companies and owning them for the long term. Lynch walks through a string of real-world surprises, including the sudden 1,000-point plunge in October 1987 to show how often experts and economists get it wrong. There are tens of thousands of economists and countless market pundits, yet nobody consistently sees recessions, booms, interest rate turns, or crashes ahead of time. Even when forecasts look confident after the fact, those are usually hindsight stories, not reliable foresight. He calls out a common human habit he calls penultimate preparedness. We always prepare for whatever just happened. If the last crisis was inflation, we build defenses for inflation. If the last shock was a crash, we prepare for crashes. The result is a cycle of overreaction and misplaced security, because the next problem is rarely the same as the last one. Lynch offers a memorable rule of thumb he calls the cocktail party theory. Imagine how people at a party talk about stocks. In stage 1, after a long slump, nobody talks about stocks. People would rather talk about going to the dentist. That is often when the market begins to recover. In stage 2, more people show mild interest. The market is up, but most are still not engaged. In stage 3, after a sizable rally, people circle around the investor and ask what to buy. In stage 4, everyone is giving tips, including your dentist, and that is a classic sign the market is near a top. Lynch warns, when your neighbors start telling you their hot picks, the market is probably overheated. A central theme of the chapter is that the overall market level, points on the Dow Jones or other broad indicators, should not drive your buying decisions. Lynch quotes Warren Buffett's blunt idea that the stock market doesn't exist as anything but a way to find foolish prices. The important thing is the individual company, its competitive position, earnings power, and price relative to value. Buy a great business at the right price and the market's gyrations become largely irrelevant. Examples underscore the point. Some of Lynch's favorite 10-bagger stocks made their biggest moves during bad markets. Taco Bell ran up even through recessions, and a small mutual fund turnaround became a 20-bagger during a down period. Conversely, knowing the economy will boom does not help if you pick the wrong company in that sector. Lynch explains that even if you could foresee a big economic theme, you still must pick the right firms. He gives examples of companies that were perfectly positioned for booms yet failed because of poor management or weak fundamentals. Picking markets without doing the company homework is virtually the same as gambling. Throughout the chapter, Lynch peppers practical advice with blunt common sense. His main points are: do not overestimate the wisdom of professionals. Many institutional investors are hamstrung by rules, committee thinking, and fear of looking wrong. Use what you already know. Everyday observation. Your neighborhood store, the products you or your friends buy, can point to promising companies before Wall Street notices. Look for under-the-radar opportunities where fundamentals are sound but analysts are few. That's where 10-baggers often hide. Put your energy into understanding companies, not forecasting the market. Fundamentals matter far more than headlines. Ignore short-term noise. Large short-term swings are normal. The longer horizon smooths them out. Be honest about whether stocks suit your life stage and temperament. Stocks are not right for everyone all the time. Lynch closes by stressing that markets matter less than people think. If you find good companies at reasonable prices and hold them while their stories progress, the market will take care of itself. He reminds readers that even the greatest investors, like Warren Buffett, sometimes step aside when they cannot find attractive opportunities. But for most of us, the best signal is a company we understand and like, not a forecast about the next quarter or the next cycle. This chapter is a steadying voice. Stop asking whether the market is good or bad, and start asking whether the company in front of you is worth owning. If so, it is almost always never too soon or too late to buy.